discussed in the program. The station does not guarantee the results of any investments made by a listener to this program.
The Word on Wealth with Gary Quackenbush is sponsored by the Word on Wealth Radio Network.
This is the Word on Wealth with Gary Quackenbush of GQ Law. Gary is a San Diego financial solutions attorney, protecting people like you. The Word on Wealth team of financial experts is here to answer your questions and help preserve your family's financial future. Now, you're live.
Happy Monday, everybody. This is Gary Quackenbush, your host here on the Word on Wealth. Good to have you along. Thank you very much. We have in our show today, we've got the second half. We're going to talk about tax. It is tax time. You know, you got your tax deadline. If you have an out-of-state tax return that has to be filed, that means your federal deadline is tomorrow. So hopefully you are on top of that. I know in California, we were, if you're in one of the counties where it's the declared disaster area because we had some rain or a lot of rain. Some people really was a disaster. Others, it was a political disaster. But 2 counties opted out of it. So if you're in those 2 counties, your tax deadline is tomorrow. And if you are in any of the other counties, that's fine. You have you can wait. However, if you have an out-of-state return, the way it works is if you have a state return and that state doesn't recognize the disaster, California does. It was a California disaster. So let's say, for example, that you need to file an out-of-state return in Utah because you have some income property there. So you got to file an out-of-state return. Well, Utah is not a disaster state like California was. So they're not going to extend unless you actually request an extension. So your deadline would be April 18th. State tax returns are based on preparation of an accurate federal tax return. So even though the IRS says, yeah, you don't have to file your tax returns until October 17th, the state says, well, we need you to get a federal tax return ready and accurate so that we can get the state tax return filed on time. So just don't be thinking like everything else during this pandemic, we're kind of in 4th quarter of the pandemic. During the pandemic, it seemed like everything was forgiven. It was moved off. It was canceled. Somebody else's responsibility. The government will save you, all that kind of stuff. It's not necessarily the case now. So keep your eyes peeled. Make sure your tax pro is on top of it. Don't do your tax returns yourself. Have somebody take care of it for you. All right. So in the second half of the show, we're going to talk about tax specifically. We're going to have Rich Mathurin from GQ Law. He's our other attorney, and he deals with taxes, tax problem solving, debt management. He deals with guardianships, conservatorships, trust administration, probate disputes. That's Rich. He's amazing. He's incredible. We love to have him on our team at GQ Law, and I'm glad to be part of that team. So he's going to be on as our regular guest. He's on every Monday, so you can call and ask him questions if you have them coming up at the half hour. Okay, so then our regular week, you got me tomorrow, you got Wednesday, we've got Ken Pecos, our real estate expert, incredible, brilliant real estate expert, super fun to talk to, super fun to call in and ask him questions. You can't stump him. He's super smart and he's very personable, very intelligent. It's super fun to have him on the show. That's on Wednesdays. On Thursday, we have Anthony Wright, our financial guru. And on Friday, we have Finding Joy Fridays. And that's going to be, we're hoping to get Edwin Edabiri. We'll see if we can get the ambassador of joy. Other than that, we've got other guests that are lined up for that day. So that's your weekly outline. Looking forward to having you along for throughout this week. Now, if you have questions of me, the number here at the show is 888-344-1170. So 888-344-1170. And you can get on the air with me and ask me your questions. I'd be happy to answer them for you. I can almost always answer your questions. If I can't, then I will give you, I can talk to you offline or give you a way to get your questions answered. Okay. Other thing, I know a lot of business, right? On the 27th. So that's a couple weeks, week and a half, 10 days. On the 27th, we're having a seminar. It's an estate planning seminar. It's going to be in Mission Valley. We rented a small room because we only, I'm the guest speaker. It's a small room. It's filling up, but we do have some seats available if you call. So you need to call right away, please. It's 10 days from now. Call my office number, 855-500-TRUST, and just say that you want to get in on Gary's estate planning seminar. They know what you're talking about, even if you fumble through it and say, I don't know what Gary was saying, something about a seminar. Yes, it's a free estate planning seminar. You'll be able to ask your questions. I'm going to be talking specifically how it works and give you some ideas. We'll talk about funding too, how to maintain your living trust, because I think that's the biggest thing. Funding and maintaining living trust is kind of the big deal. I see a lot of trusts. I review them. For my listeners, I review trusts for free. I usually get into the question of what is in it and what how has it been funded? Do you have a house in there? Do you have retirement accounts? Is that appropriate? Is your trust set up for retirement accounts? Do you have investment accounts, money accounts? Is that stuff in your trust actually in the trust funded properly? And 75% of the time, I know that seems like a big number, 75% of the time, the bank accounts are not in there. The retirement accounts have nothing to do with it. The life insurance is not going into the trust. You don't have, a lot of these things that you need to think about, but we're going to be talking about that. I will show you how to fund and maintain living trust at the seminar on the 27th. Call 855-500-TRUST. All right. Talking about different trusts. I want to go, some of them are kind of fancy and interesting. I've had some things, and what I'm going to do is I've had some people talk to me in the last, let's say 4 weeks. And over the last 4 weeks, there's kind of a theme. And I see that once in a while, there's kind of a theme, and I don't know why, but it makes me believe that this is something that you all want to hear about. So I want to talk about blended families and trusts for blended families, because there are different options available. And we're still talking about living trusts, family trusts, joint trusts, separate trusts. I want to go into that a little bit in today's show so that you understand as blended families, which a lot of families are blended families. Probably about 70% of families are going to be blended families, over half for sure, because the divorce rate's up over 70%. So I want you to understand how estate planning works for blended families. It's a little bit different because I just think there's more to think about, especially if you have, maybe the husband has children and the wife has children, and between the two of them, they have another child or not. But those are the type of things I want to talk about. Also, is it necessary to put your car in your trust? I think that's something that should be done. Most people do not do it. I appreciate when I'm doing the administration and distribution of people's trusts. I love it when there is a car in the trust rather than having to mess around. There's about a 1.5 month waiting period if it's not actually in the trust. It can be managed, but it just depends on the value of the trust. You're listening to The Word on Wealth. This is Gary Quackenbush. If you want an appointment with me to review that trust or to come up with your own estate plan, I'm happy to get you a custom estate plan. We'll talk about it. Call me up at 855-500-TRUST. Call today because the week is filling up. 855-500-TRUST. Get on my calendar. Come in and see me about your living trusts right here. Talk to you soon.
You've got questions. We've got answers. This is The Word on Wealth with Gary Quackenbush of GQ Law. Gary's here to give you peace of mind with expert estate planning, trust administration, inheritance, and probate. Call Gary to build, protect, and transfer your wealth. 855-500-TRUST. GQLaw.com.
You're saving and investing for the future, and that's good. Have you ever stopped to think, where does my money actually go? This is faith-based investing with Anthony Wright.
Most Christians just don't understand that the money they save for retirement usually helps fund the abortion industry and other liberal anti-family causes. But did you know that with just a few minutes of your time, we can screen and clean your investments at no cost to you? It's absolutely complimentary. Just go to the website right now, download a free copy of my book, Faith-Based.
We have a caller. I'm screening it because he says he specifically wants to talk about income tax, and I know Rich that's kind of Rich's thing. Do you still want to answer the question or no?
I'm probably not going to do income tax today.
Good.
You can call my office and talk to my tax guy.
Learn more now.
Okay, I'll just have him call the office or call in tomorrow.
Yeah.
Okay.
Your free book is waiting for you. Go to BibleSafeInvesting.com and be sure that you listen to Faith-Based Investing this weekend right here on Family Car.
Gary, how do you and your team help our listeners avoid probate?
Well, first of all, probate is a process that involves attorneys, judges, and sometimes contesting parties. And so we try to avoid probate at pretty much all costs. The way we do that is setting up living trusts, setting up properly documented wills, putting the property like houses, cars, bank accounts in that trust so that it avoids probate. Probate is only necessary if the estate plan isn't set up quite right. So we help them get it set up right. And mainly that's done through a properly created living trust.
Call Gary and the team at GQ Law, 855-500-TRUST, or go online and download Gary's free ebooks and videos. Read Gary's blogs, call or click to request your free initial consultation. That's gqlaw.com, 855-500-TRUST.
Who will you trust with the biggest financial decision of your lifetime? If you're planning to buy or sell a home in San Diego County, do what I do and work with the true San Diego real estate experts. Ken Pecos and the Pecos Group helped me and my family. They can help you. This is Gary Quackenbush, the Word on Wealth. You hear Ken every week here on the Word on Wealth. He's our expert. He's got integrity, exceptional service, deep knowledge of the San Diego, Coronado, and South Bay regions. These are just some of the reasons that Ken Pecos has completed hundreds of transactions. He manages a powerful team of professionals at the Pecos Group. From single-family attached homes to luxury high-value waterfront properties to apartment buildings, Ken Pecos is ready to help you avoid problems and costly mistakes. Learn more online at kenpecos.com. That's Ken Pecos, Pecus.com. Or call 619-977-8419.
DRE number 010566969, brokered by eXp Realty.
Free initial consultation or to talk with a member of the team. Call Gary at 855-500-TRUST. GQ Law.
July.
Right. Welcome to Word on Wealth. If you got questions for me, 888-344-1170. We're talking about trust for blended families. And coming up at the half hour, we're going to have Rich Mathurin from GQ Law. He's going to be in here. We're going to be talking about tax problem solving. If you struggle with taxes or tax difficulties, if you have friends, you want to learn about that, that is coming up next. It's just something, the reason we address it is because there's a lot of, it just happens to a lot of people. I mean, during the pandemic, the IRS kind of relaxed its collection standards, or, they just don't have that many people to collect all the billions of dollars that need to be collected. And there's a lot of, I think, false advertisement out there on promising that companies can hand you the moon as long as you pay them your, $8,500 and give them your second born child. So we want to just kind of clear that up. That's something that GQ Law has been doing for many years, and it's an offering that we're offering. We do that type of work as well. Blended families. When I talk about a blended family estate planning, really the definition of a blended family is that there's children from different relationships. So husband and wife at the time. And I'm just going to use standard terms. Okay. That's just me. I don't want to get into, anyway, whatever. So it's like husband and wife. So in a blended family situation, it's literally has to do with kids. It doesn't mean that it doesn't matter that, the husband's been remarried or been married 3 times before and the wife, 2 times before. It doesn't matter. What matters is their children. So blended family is when you have a family being blended by marriage. That may seem pretty obvious, but I don't necessarily always think it is. Okay, so example is husband has 4 children and wife has 3. They get married. There's 7 children. So in a trust document, if you did a joint trust and it's husband and wife trust, and they refer to our children, what does that mean? Remember, when we're doing documentation like trusts and wills, we're trying to make sure there's no confusion, because when you die, when you're both gone, we can't ask you what you meant. We can't ask you, what did you mean by that? You know, your attorney is, we don't know where that attorney is. We don't really care that much where that attorney is. It just is confusing to us. The documentation in your estate plan needs to be done without confusion. That's why I always say, don't do it yourself. It doesn't make any sense to me. If you're trying to do a document that's going to be very important to eliminate confusion or help reduce confusion, when you die, there's a lot of confusion. It's a mess. And whoever your successor trustee is of your living trust, that person is going to take over your financial life and do what you did while you're doing what they did and taking care of their things. So they drop into that and try to do the best they can to step into your shoes and manage your financial life until that money can be distributed according to your wishes. It's a lot to ask of somebody. I've never had a successor trustee that was really mad about it. Like, I can't believe my dad did this to me. They're always willing to serve, but why not make it easier? So the things that make it difficult are not looking down the road very far. Okay. By that, I mean, you do this trust. Husband's got 4 children, wife's got 3 children. They get married, they've got 7 children, and they do a trust because they go online and they say, we love each other so much that when we are both dead, we want our children to share all of our property, 1/7 each. Okay. Great. Maybe that's a great plan. Whatever property you have is in a big pool, and when you die, it's going to be split up equally between the children. Now let's look forward about a little bit further than that. Okay. Instead, the wife dies first. She has 3 children. Husband has 4. When wife dies, the 3 children of hers have no relationship. They're legal strangers, excuse me, to her husband, her now ex-husband, her widow. Okay. So those 3 children are legal strangers. And not to be awful about it, but what would happen in that situation? Will the 3 children of the deceased spouse, are they going to be as involved in the life of the surviving spouse? You know, mom's, second husband? Are they going to be involved in their life? And I would venture a guess and say no, because that's not their dad. And dad, the husband married the wife, 5 or 10 years ago, and these kids are 20 years old. So he wasn't there for half their life. So the relationship is going to change. Okay. Is the surviving spouse going to hang in there and say, okay, this trust says that when we are both gone, all the property goes equally to our 7 children. So 1 year goes by. That seems okay. If I die tomorrow, I'm happy sharing it with my wife's children. And then 5 years go by, and then 10 years go by. And then it's like, are the wife's children paying attention to you anymore? Maybe not, probably not, because they have their own family, their own thing. They got their thing going on. So now you're thinking, oh, well, that's interesting. Now I've been around for 10 years more, and the property is worth more. And my deceased spouse didn't do anything else to increase the value of the property. I've done it all. Why should I share that much with her children? And so you go and amend the trust or change the trust. I'm not trying to be mean about it. That's just reality. We got to look further ahead. It's okay initially to think, okay, we do an estate plan. When we're both dead, what's going to happen to our property? Okay, that's awesome. I mean, I don't want to outlive my wife. I don't want to die young either, but I really don't want to be the surviving spouse. And honestly, I don't really want to leave her as the surviving spouse because, I like being with her. She likes being with me. And when one of us dies, it'd be nice to follow along, right? So, but there typically is a survivor. And we got to think about that. The reason you hire a guy like me is because I have this ability from multiple years of experience. I have the ability to look down the road further and say, okay, what if husband died and wife died 20 years later or 10 years later, or 15 years later? What if wife died and husband lived for another 15 or 20 years? What about remarriage? What's going to happen with that? And that's where you kind of get into the funky spots. It's like, okay, wife dies, husband remarries because he really liked having a wife and loved that companionship, and they traveled together and they spent time together and they were not lonely because they were together. And that happens when your spouse dies, then sometimes people want a companion again. And so he goes and decides to remarry. Well, what if his new spouse has her own children? There's 3 more children. What's with the estate plan now? Deceased spouse, surviving spouse, new spouse. What does our children mean? And so you just really got to watch out, I think, for terminology, and you got to watch out with blended families and make sure you do a great job. Okay, so what I initially recommend is that depending on your asset structure, which we've got to get into some detail exactly how it's going to work, is what's going to happen with each asset at the time of both dying, and then what's going to happen with each asset if one dies first, one spouse dies first. So we got to talk about who gets to use the house, who gets to use the, the retirement money, who gets to spend this, that's the stuff we got to talk about. I'm not talking about a prenuptial agreement or anything like that, or a postnuptial agreement. We're talking about estate planning. And I think those are the things you really want to look down the road a little bit further. What I have a lot of my blended family clients doing is the husband sets up his own separate property trust and wife sets up her own separate property trust. And each of those trusts have their own distribution. It may very well be that wife's property, when she dies, goes directly to her children and husband's goes directly to his children. Maybe that's the way you do it. But what if husband dies first? Do you want to give all the property of husband to his children? Will that leave wife with enough money? Does she have her own house? Does she have a place to stay? Does she have enough money to survive? Or do we need to instead say, husband's trust says, when I die, if my wife is still alive, then she can live in the house for the rest of her life. And if she decides to move out, doesn't want to be there anymore, gets remarried, then the house gets sold and distributed to husband's children. You can do that. Or you can put conditions. I mean, I've had people that will say, okay, I want to do it this way. If husband dies, if husband dies first, then wife can stay in the house for 5 years. And after 5 years, the house gets sold and the money gets distributed to husband's children, or to husband's children, one share to each of husband's children and one share to his surviving spouse. So it was, if he had, in my example, what we're doing, husband has 4 children. So it'd be 1/5 to each of his children and 1/5 to his surviving spouse. So that'd be one way to do it. So she gets to live in the house for 5 years. Then the house gets sold, 1/5 to each of husband's children, and then 1/5 to that surviving spouse. So she has some money, and she had 5 years to get, on her feet and make sure everything was taken care of. And then there's some money available. But sometimes the things it's really important to kind of go through that process and see what your options are. And you can't do that on your own. Okay. Do it yourselfers. I love doing it myself. I love DIY stuff. But when it comes to like legal stuff and estate planning, documentation, dealing with, other people in a companionship, partnership agreements, limited liability companies, corporations, marriages, all those things they're going to end someday. That just happens. And we need to figure out what the exit strategy is. So when you exit this life, what's going to happen to your stuff? Can your spouse continue to use that stuff, or is he or she well enough off that they don't need to? Do we need to cover that with life insurance? Do we need to do some other things? And sometimes that's the way too, is you have it so that husband and wife each have $1 million of life insurance. Okay. And that way, whichever one dies, the other one gets the $1 million. That may be enough to then let, husband's kids get money and yet still have $1 million going to wife. So there's a lot of those things, but those are the conversations that we have. That's just to get to the basic estate plan for blended families. It's really important to get it right. Blended families are a big deal, and you got to get it right, because I'm trying to look down the road for you. It gets even fancier, more complicated if you have husband has kids, wife has kids, and then they have kids in common together. Then we got to think more carefully. Do we need 3 trusts? Can we do it with one big trust? How does that work? And there are ways to do it. And those are conversations I love to have. 855-500-TRUST. My week is filling up, but if you want appointments within the next week or so, got to call pretty soon. 855-500-TRUST, 855-500-TRUST. And while you're at it, sign up for my seminar. It's on the 27th. It's going to be April 27th in Mission Valley. Call now. You got to get a seat on that one, because that one's filling up. 855-500-TRUST. Come to my estate planning seminar with a real estate friend of mine. All right. Coming up next, we got Rich Mathurin from GQ Law talking about tax problem solving. We'll be right back.
You don't need to know everything. You just need to know where to find answers you can trust when you need them. Welcome to the Word on Wealth with Gary Quackenbush. We are here to help you build, protect, and transfer everything you've worked hard for with expert estate planning, trust administration, inheritance, and probate. Call Gary and the team at gqlaw.com. 855-500-TRUST.
You're live.
Welcome back to the Word on Wealth. Guess who's here? We got Rich Mathurin, our tax attorney here at GQ Law. GQ Law is the sponsor of this show, so that's why we have Rich on our Tuesday show.
Monday.
Oh my goodness, it's Monday.
Time's just flying.
I know. I asked Rich when he came in the studio. So, Rich, how's your day going? He goes, okay, here we are. I mean, yeah, we are 3/4 of the way through the day, kind of, right?
Yeah, it is almost Tuesday.
It is almost Tuesday. When I started the show, and sorry, you listeners, I know somebody called up and said, I have a tax question. When I said tax, yes, Rich and I are both tax attorneys. Rich more than me. He deals with the tax. It's when somebody already owes money, like Rich will do. Gosh, we've we've had Rich. The thing is with, I don't know. I guess if Rich knew all the things he was gonna have to do when he came on board, I don't know. Maybe he would have gone, yeah, I don't know. But Rich has learned a lot of new things. I've learned a lot of new things with him here. I mean, gosh, one of the crazy things. Well, you remember when you first started here? The first thing you do is I go, yeah, we're in the middle, literally the middle of this messy appeal of an audit. Remember that one? And it's like, it was up in, where was it? No, it was north of here, up in Riverside County. So you had
Orange County. Yeah.
in Orange County. That's right. And then you had to work that thing. And I felt kind of bad because I've done audits, I've done appeals and tax court work and all that. And then you learn that really fast. But I just always think about that, beginning of the pandemic, you started working for me, pandemic hits. And then it's like, hey, Rich, have you ever done like this massive, nasty appeal? No. All right. Figure it out. And then you did a good job on that.
Yeah, we settled for both. It was both a personal and a business for the client. So we did have successful resolution in both. So that was good.
That's right. That's right. And sometimes that's right. I forgot it was both of those. Gosh, you had we did like a sales tax crazy audit thing that was resolved pretty recently.
Yeah, still working with those clients on some IRS and FTB issues, but they did have a sales tax thing that we did get resolved for them. So
Yeah.
CDTFA, I'm not exactly California Department of
Okay, CD. It used to be. It used to be State Board of Equalization, which made no sense to me at all. So now it's called the CDT, California Department,
taxes, tax
and fines, taxes and fees or something.
Yeah, I believe administration. Yeah,
administration.
Yeah, so
that's just funny. That was probably a little $250,000 project for something. What should we rename this? And then that's their rebranding. You wouldn't think the government would need to rebrand to scare everybody, but I guess they did. So, hey, have you heard, and this is totally off the wall. We didn't rehearse this or anything, but have you heard, is the IRS, are they caught up yet from the pandemic, or are they still kind of in the fourth quarter of the pandemic disaster?
we've heard rumors of still sitting on several truckloads of mail. And I'm starting to hear from local revenue officers about our bigger cases. Some of the smaller people maybe still are flying under the radar, but the revenue officers that are here locally in San Diego County have been contacting me and starting to try to make waves on some of our bigger tax owing clients. So yes.
So picking back up, because it seems like all the kind of, I know, government backed off because of the pandemic and all that kind of stuff. That stuff's really starting to go away, and we're just starting to see the pickup on. Yeah. And the one thing I did want to talk to you about is, one of the big solutions, by the way, this is the Word on Wealth. We got Rich Mathurin here. If you have questions for Rich, call us at 888-344-1170, 888-344-1170. You can ask questions. We're talking about tax problem solving. It seems like, I know with me, what I've noticed is there's a huge increase in companies that are advertising, and they are making these. I listen to them and literally give me chills where all these promises are making. I mean, this one commercial that I heard, it said, the IRS is willing to make deals or is willing to forgive up to $86 billion in taxes. You have to call and apply today. And I immediately thought, oh my gosh, I got to talk to Rich about that. And we'd mentioned that before. It's like, I know where they're getting the $86 billion from. That's the quote tax gap that the IRS is trying to collect. But it just seems like there's a lot more organizations, companies that are jumping in and saying, hey, we're going to, promise the moon. Let's talk about like some of the tax problem resolutions that you've been successful at, and then kind of get into a little bit of the reality of the offering compromise.
Yeah, I have a lot of clients that call me up and say, I can pay right now. The IRS something will they waive the interest and penalties and, compromise on some of the years? And I could say yes, but the offer and compromise program is a very specific thing. It isn't that you have a certain amount of money on hand that grandma gave you, or you won the lot, you won at the track or whatever, and you can just offer to the IRS in settlement of your balance. It's really a program. The offer and compromise is a very specific program. If there's two caveats, if you can pay in full under an installment agreement, either through your income or through your assets, then they're going to push you into the installment agreement. But with the offer and compromise, it is kind of an application process. I want to say, simply put, it's 80% of the equity in your assets. So if you have a home and you have equity in that, if you have a retirement accounts and you have 80% of that, bank accounts, equity in vehicles, that all counts and towards the offer and compromise, plus your net income. That would be your income from all sources, less your allowed expenses. So if you're an individual, you're only going to be able to get IRS exemptions for food, housing, and whatever for a single person based on IRS standards. And whatever that net income number is times 12, and you add those two together, and that's what your offer and compromise is. It isn't, whatever you determine you think you can afford right now to offer them. So it's a very, very specific program. It is a great program, but it does have those caveats that you've got to make sure that you do, one, qualify, and that two, that the number that the offer calculates to is something that you can afford and makes sense based on what your actual tax balance is.
So let me ask this, Rich, so let's say somebody decides they want to submit an offer and compromise. It is possible to submit an offer that there's no way they would accept. By that, what I mean is, you've probably seen people that will submit the offer themselves, or maybe they'll go to some organization that says, we'll do an offer for you. And they put in the paperwork and the numbers on it. It just doesn't even make sense that they would even submit an offer. So it's like the IRS will at least not accept, but they'll receive a request on an offer, even if it's ridiculous, right?
Yes, there's a 20% down pay.
2 minutes.
You have to, so if your offer was like 10,000, you have to pay $2,000 down plus an application fee. And if the offer is rejected, the IRS keeps that 20%, applies it to your tax balance. So I guess you're paying in a sense,
right? And
then they get the application fee, but then they can reject it. They have an offer specialist, and they review the numbers. And if they can say that we believe you can afford this, or we want you in an installment agreement, your paperwork is not complete or whatever, so they can reject it for any reason. And
but they still call it's still like, but I submitted an offer, and it's true. No matter if you put in an offer that's no way going to get accepted, like Rich said, they're going to keep your 20% deposit, which is required. But it's like, you can submit an offer that there's no way that it will work. And I'm not saying do it. I'm saying do not do that. But there are firms that will take your money and say, oh yeah, we'll submit an offer. We'll do it today. We're going to put in an offer for, $500 and see if the IRS will take it, knowing that there's no way on the planet they would take it. So you have to put your 20% down, which is like $100. What's there to lose? You get a collection delay and all that, but it's a waste of time. And my understanding is that if you do that, the IRS goes, okay, well, that's one try. And now you submit another form under the same circumstances. Sometimes the IRS could say, you've already tried it once. But the thing is, I think, Rich, where I'm kind of going with that is that it makes a difference to the IRS, doesn't it? That you're going to put together an offer that really is within their standards. I mean, if you submit something that there's, you owe all this money and you're offering them $100, sure, you can send in the paperwork, but they're not going to accept it. And it's kind of a waste of time. And if you pay somebody to do that, it's a waste of money. You're listening to The Word on Wealth. We're going to take a quick break. When we come back, we're going to talk a little bit more about the offer and compromise program. If you got questions for Rich, it's 888-344-1170, and you can be part of the show. This is The Word on Wealth with Gary Quackenbush and attorney Rich Mathurin, and we'll be back in just a minute.
You've got questions. We've got answers. This is The Word on Wealth with Gary Quackenbush of GQ Law. Gary's here to give you peace of mind with expert estate planning, trust administration, inheritance, and probate. Call Gary to build, protect, and transfer your wealth. 855-500-TRUST. GQlaw.com.
So, Gary, we've talked a long time about estate administration. So, what is that? And why is it important?
Estate administration is the distribution part of estate planning. So when someone passes away and they leave money to beneficiaries, the property has to be administered. So it's like taking it from the decedent to the survivor. That's called the estate administration process. So usually you're going to have a successor trustee that's named in the trust. So have no idea what they're doing because they've never done it before. So then they call on GQ Law and we walk them step by step on how to be a successful and good successor trustee. We also do the required notifications. We notify the Department of Health Services and all the legal requirements so that they can have the estate administration done properly. We help successor trustees be successful.
Call or click to request your free consultation. GQlaw.com. 855-500-TRUST. GQlaw.com.
Who will you trust with the biggest financial decision of your lifetime? If you're planning to buy or sell a home in San Diego County, do what I do and work with the true San Diego real estate experts. Ken Pecos and the Pecos Group helped me and my family. They can help you. This is Gary Quackenbush of The Word on Wealth. You hear Ken every week here on The Word on Wealth. He's our expert. He's got integrity, exceptional service, deep knowledge of the San Diego, Coronado, and South Bay regions. These are just some of the reasons that Ken Pecos has completed hundreds of transactions. He manages a powerful team of professionals at the Pecos Group, from single-family attached homes to luxury high-value waterfront properties to apartment buildings. Ken Pecos is ready to help you avoid problems and costly mistakes. Learn more online at kenpecos.com. That's Ken Pecos, Pecus.com, or call 619-977-8419.
DRE number 010566969, brokered by EXP Realty.
Tell a friend about this broadcast outreach, The Word on Wealth, with Gary Quackenbush of GQ Law. Call or click to request your free initial consultation or to talk with a member of the team. Call Gary at 855-500-TRUST. GQlaw.com.
You're live.
Hey, well, whoa, there we go. Hey, how about a microphone? That works better. You're listening to The Word on Wealth. So good to have you along. Happy Monday, everybody. We've got Rich Mathurin from GQ Law here. Got him right here in studio, asking him any question we want. If you guys want to call and ask Rich a question, it's 888-344-1170. We were talking about offers and compromise. So, Rich, with an offer and compromise, usually is an offer and compromise, is that for somebody, kind of two scenarios. I think in terms of somebody goes to file their 2022 taxes, they put all the filings together, and lo and behold, they've got a $40,000 tax balance. It's like, oh my gosh, I have to do an offer and compromise. Is that kind of an offer and compromise situation? Or is it more somebody that hasn't filed for a number of years, or they got this big, huge back mess?
I think it can be both, but I want to build on what you had talked about before the break.
Okay.
If a company just says, we'll submit an offer and compromise and doesn't look at your situation, again, your assets and your income, and determine whether you're a good candidate, because maybe the $40,000 person, had one great year and then he's lost his job. He might be a perfect candidate for the offer and compromise, but maybe he's working and he's getting a good salary and he can pay his $40,000.
Right.
They have 10 years to collect. So they can basically, the IRS is going to put him into a payment plan. So please whether it's us, and I hope it is us, or another, make sure that it's a reputable firm that just isn't going to submit your offer without doing any analysis of your situation. Because if it, if the IRS, if you have too much in income or assets, they're going to push you into an installment agreement, reject your offer, keep your 20%, keep your application fee. And one other thing I should mention, it does stop collections while you're in the offer, but it also stops the statute of limitations running on your balance. Remember, they have a 10-year from the date of the assessment until for 10 years they can collect on it. But while you're in the offer, it tolls or stops that the running of the statute of limitations. So please make sure that it's a reputable firm, because these my understanding from you, Gary, is that they take $5,000-$10,000 of your money up front and submit your offer without even looking at whether you're a candidate for it. You have to be able to pass the equity and income tests. Plus, it has to make sense from a financial standpoint. If the offer comes in at 39,000 and you owe 40,000, does that really help you at all?
Yeah, and that's the thing that I'm trying to caution. I mean, I guess in doing this as many years as I have, it really frustrates me, not that it's competition, but it frustrates me that I have talked to so many people that have come in and said, yeah, I went to such and such a firm and I had to pay them $8,500. I did $4,000 up front. It was $500 a paycheck for all this period of time. And they submitted an offer in compromise and it got rejected. And I go, okay. And what did they do after that? Well, I got a letter that said, yeah, your offer in compromise got rejected. If you'd like to submit another one, it's $8,500. And we could, it was like the same process. And I started seeing that and thought, this is really ridiculous. You have somebody that's got a tax problem that's really wanting help. And then you make all these promises. And sure, you can put together an offer in compromise and submit it, and they'll accept the filing. But then once it gets processed in about 2 or 3 or 4 months, they're going to reject it. Well, that was a total waste of money. And what I'm afraid of is that people are just being sold something that is not going to work. And if they had looked at it, they would realize it. We had somebody call the other day, and we were screening the call and trying to see if it's something would help. And it was a woman that called, and she said, I called such and such a firm, and they said that, so we started talking about the numbers and all that. And she said, they told me it would be $6,500 for an offer. I said, what is that? What does that mean? And she told me, she goes, I would like $20,000. She said, it's $6,500. I said, is that to submit the paperwork or what? And she said, oh no, the nice lady on the phone told me that the $6,500 was it, that all I had to do is pay $6,500. That's going to cover all the fees, all the costs, including the amount that the IRS would accept, and that they would accept, it was in the $6,500. And so I was trying to get really specific. It's like, I don't want to be mean, and I'm not trying to treat you like you're dumb, but did they actually say that the $6,500 would be it, including the filing fee and the amount you have to pay the offer? And she says, yes. And it was like, I don't know whether the receptionist was lying or just didn't know better, or was trying really hard to close the sale. But that really frustrated me because, just to get a client to come in to make these promises that are just ridiculous. I had another one that had called, and it was kind of really similar. And they said, but I don't think they're telling the truth. I said, what do you mean? They said, well, I have a house with $100,000 of equity, and I owe the IRS $50,000. And they were telling me, yeah, the IRS will accept pennies on a dollar. She said, it doesn't make sense. How could I have $100,000 equity and a retirement account and some money in savings? All I want is them to cut, get rid of my penalties and interest. And this firm is saying, yeah, you can settle the thing for pennies on a dollar. And those are the things that really frustrate me. And I know they frustrate you as well. So go through you said earlier, we went through the scenario, like what is an offer? What does it mean? So when you're saying that the offer is going to be 2 parts, one, it's going to be equity and assets, like net realizable equity and assets, and it's going to be disposable income times 12, basically. So talk to us about, what does it take to calculate the equity and assets? Like what gets included? What do we not have to put in that paperwork? Or, what gets excluded from the calculation? You guys, you're listening to The Word on Wealth with Gary Quackenbush and Rich Mathurin. Rich is an attorney with GQ Law. If you have a question for him, it's 888-344-1170. Or if you want to call us directly to go to our estate planning seminar or talk to Rich about your tax situation, it's 855-500-TRUST. And don't forget, the seminar on estate planning is April 27th, 855-500-TRUST. So Rich, if you could talk about that, like of the assets that people have, like what does that mean, assets, and then what kind of gets included in this calculation for offer?
It's all of your assets. So it would be your bank accounts. I believe there's $1,000. You get $1,000 exemption. So if you have 10,000 in your bank account, you'd get $1,000 exemption. 9,000 have to be included. Brokerage accounts, coin, cryptocurrency, retirement accounts, 401ks or IRAs. The 80% of the value of those. Equity in vehicles, I believe you get a small exemption, maybe $3,250 of vehicle equity exemption. I mean, they're not going to come and take your car, but if you'd have to take the Kelly Blue Book less whatever you financed it for. And if there's equity in that, it has to be included in the offer. And then the big thing that I think people don't understand is the equity in your home. That would be the fair market value of it. And I guess you can argue about whether it should be the Zillow value or an appraisal or whatever. Then less whatever your mortgages are, if you want first or second mortgage, and that net equity. And then they would take 80% of that amount. So, if that lady had $100,000 worth of equity in her home, 80,000 of it would have to be included in the offer. The IRS, those are clear. That's low hanging fruit for the IRS. So.
Yeah. And yet the IRS doesn't say, wait, you can't even send us that offer because it's not going to work. They're happy to receive the offer, filing fee, 20% deposit, because if you don't send in the 20%, they're just going to kick it back. But they're happy to do that, but then they're going to process it. And I guess the thing that's a little, I don't know, I hate to always bash on other companies, but it's like the amount of time between sending it in, the IRS will then put a collection delay, and then when they process it, it's still going to be a month or two before they actually get to the process and say, whoa, this isn't going to work. We're rejecting the offer. But I think what some of these companies are doing is they're kind of selling this, hey, look what we did. We submitted the offer. And you notice the bank levy is not there. There's this collection delay, everything all quiet with the IRS. So double thumbs up. We did our job for, $8,900 or something.
Yeah. But then once they reject you, again, you're told the statute of limitations. So you lose that time, and then you're back into collections afterwards. So, and then obviously if you put the 20% down, one thing that this woman wasn't told is the remaining 80% of the offer has to be paid after acceptance.
Right.
So, if she was offering 100,000, she puts 20,000 down, and then 80,000 have to be paid over 5 months after the offer acceptance. One other thing that I think we've talked about this prior, the offer does settle your back taxes, but the IRS, one thing that's important that you understand, and a lot of people that we deal with do have issues about keeping in compliance. They want you to stay in compliance going forward for 5 years. So that means you got to file all your taxes on time for 5 years and pay all the balances when due for those 5 years. You can't incur new tax balances like it's a credit card. So do keep that in mind also.
Right. So I think that's the thing. If you come to a firm like GQ Law, 855-500-TRUST, what we'd like to do is get you into compliance where you're all set up tax-wise. And then in the future, we have tax professionals that will help you stay current so that you kind of stay on that track. And it's a great thing. I mean, you've had some tremendous success with offers that I never thought would be accepted. You've gotten them, and it makes people happy.
Yeah, it's a great, if you please call us and we can do an analysis and tell you honestly. And we have these, different tools, whether it's an installment agreement, bankruptcy, or the offer and compromise, but do call us and let us do the analysis. And the offer and compromise program is a great one if you qualify.
All right. That's a wrap today, guys. Welcome. We're glad that you're along here with the Word on Wealth with Gary Quackenbush and Rich Mathurin. We've been talking about tax problem solving. If you do have questions on that, if it's you or a friend of yours or a family member, somebody that has tax situation, go to somebody that knows what the heck they're doing. Call Rich here at 855-500-TRUST. Call Rich at 855-500-TRUST here at GQ Law. You can also go and find a lot of the information we're talking about is on our website, gqlaw.com. We've got some information and free books on there to help talk about this kind of stuff. All right. Talk to you tomorrow, everybody. Thanks a lot. Thanks, Rich.
Thank you.
Tell a friend about the Word on Wealth, featured since 1995, with financial solutions attorney Gary Quackenbush, an expert in estate planning, wills and trusts, and tax problem solving. Gary is past president of the California Society of Tax Consultants. Reach out to us. The Word on Wealth team of financial experts is here to answer your questions and help preserve your family's financial future.
The information you hear on the Word on Wealth is for general information purposes only. This program discusses general financial and legal topics. Seek legal advice from a competent lawyer for your individual legal needs. The opinion